Hi, welcome to my channel, Second PUC Accountancy, Learn, Understand and Excel. Today we are going to see another sum under dissolution of a partnership firm with a different adjustments. So this is the question given here under dissolution of a partnership firm. This is the fourth sum which comes for 12 marks. So here we have to prepare realization account, partners capital account and bank account. Anita and Sunita are partners sharing profits and losses equally. The balance sheet as on 31st March 2025 was as follows. The balance sheet is given here. So first on the liability side, we have bills payable 6,000, creditors 20,000, Anita's loan 5,000, Vanita's loan 5,000, reserve fund 30,000, and the capitals of the partners Anita 50,000 and Sunita 50,000. So these are the liabilities given here, and the assets are cash at bank 6,000, debtors 28,000, less PBD 2,000. So the balance amount of debtors is 26,000, stock is 40,000, investments 20,000, furniture 14,000, buildings 60,000. The total of the balance sheet is 1,66,000. So from the balance sheet, we'll first see where the entries will appear in the realization account and the partners capital account. Bills payable is the external liability. Creditors is the external liability. Anita's loan is Anita. When we see Anita is a part of a partner, so she is one of the partners. So Anita's loan will be treated as internal liability. Vanita's loan. Now Vanita is not a part of a partners, so it is treated as external liability. Reserve fund will go to the partners capital account and the capitals will go to the capital accounts of the partners as the opening balance. Now in the assets, now except cash at bank, all these assets, that is debtors, stock, investments and furniture and buildings, will have to be realized, and it should be closed and realized. So we write it on the debit side of the realization account, and realized amount will be given in the adjustment. Now the adjustments given below the balance sheet are as follows. The following information is given to us. First, the assets realized are as follows. Debtors are realized at 25,600, stock is realized at 39,000, buildings is realized at 66,000. So they have given us how the assets are being realized. Next we have is Anita's took over 50% of the investment. So out of the assets given, they have mentioned debtors are realized, stock is realized and buildings are realized. Now this investments is being taken over by Anita, where 50% of it is taken over by Anita at 10% lesser on its book value, and the remaining 50%, that is the remaining investments, are being sold, which means it is realized at a gain of 20%. Now the other asset, that is furniture. Now here the third adjustment, furniture was taken over by Sunita at rupees 12,000. So investments 50% is taken over by Anita and furniture is completely taken over by Sunita at 12,000 rupees. The next adjustment says that Anita agreed to bear all realization expenses. So for this service, Anita is paid rupees 2,600, but the actual realization expenses amounted to rupees 2,000. So let's see how to treat all these adjustments in the different accounts. Now let us just see the note given for various adjustments. The assets realized, that is given in the adjustments, are debtors are being realized at rupees 25,600 as per the adjustment. Stock is realized at rupees 39,000, and here investments, as per the assets given here, investments, it says 50% is realized at 10% lesser and the other 50% is taken over by Anita at 20% more. And then The next asset, furniture, given in the balance sheet, is being taken over by Sunita, and buildings are realized as per the adjustment at rupees 66,000. Now, this is the note with regard to the assets that are realized and the assets that are taken over. Now, here we have to see a note on the investments. So, as per the adjustments, it says the investments 50% is realized and 50% is taken over. So, let's see the note on the investments, how to calculate. So, this is the note given here. The value of the investments as per the balance sheet is 20,000. If you see the balance sheet, the investment value is 20,000. Now this 20,000, how it has to be treated as per the adjustment. So firstly, it says 50% of the investments is taken over by Anita at 10% lesser than the book value. That is at a discounted value. So first let's find out how much is the 50% of 20,000, which is 20,000 into 50 by 100, that is 10,000 rupees. Now this 10,000 is the value of the investment that is taken over by Anita, but she takes it at 10% lesser than the book value. So we have to deduct less 10% discount, that is 10,000 into 10 by 100. So discount will be 1,000 rupees. So the value of the investment that is taken over by Anita is rupees 9,000. So this is the asset that is taken over by Anita, and she takes the investment at rupees 9,000. Now what happens to the other 50%? The other 50% of the asset is to be sold. Now the value of the investments that are sold is the remaining investment, that is 50% of 20,000, which will be 10,000 rupees. Now here this asset is being sold at 20% more, that is at a gain value. So we have to add the 20% of rupees 10,000, which will be 10,000 into 20 by 100, which will be 2,000 rupees. So 2,000 rupees is the added value or the gain on the investments sold. So we have to add the value, therefore the value of the investments sold will be rupees 12,000. So investments is partly being taken over and partly it is being sold. The asset that is taken over will be transferred to that particular partner's capital account, that is Anita's capital account. The asset that is being sold will be recorded under the bank account. So this is how the treatment to be made for the investments that is being given here in the adjustment. That is 50% investments are being taken over and the remaining are being sold. Now next let's see a note on the liabilities. The liabilities are being paid. How it is paid? So in the adjustment, if you see, they have not mentioned about the liabilities, how it has to be paid. So we will always assume that all the liabilities are paid in full. So what are the liabilities given here in the balance sheet? We had seen bills payable. So since it's not mentioned, we pay it in full, and creditors is also paid in full. Now the next liability is Anita's loan. As we know that Anita is a part of a partner, part of the firm. So Anita's loan is treated as an internal loan. Therefore, internal loan will be directly transferred to the bank account. And next is Vanitha's loan. Vanitha is not a part of a firm, so she is an external person. So this is treated as an external liability which has to be paid in full. So this is how the liabilities are to be treated as per the adjustments. Now if you see the last adjustment given here, Anita agreed to bear all the realization expenses, and for this service Anita is paid rupees 2,600 and the realization expenses amounted to rupees 2,000. So here the Anita has agreed to take the realization expenses, and for which the firm is paying some additional amount. So in this case, the actual realization expenses should be ignored. It has to be ignored and consider only the amount, total amount that is paid to Anita. So since the expenses are directly taken over by Anita, it is treated like expenses taken over by the partner. So Anita's account will be written on the debit side of the realization account as to Anita's account, and the amount will be rupees 2,600. So ignore the actual realization expenses. So this is how the adjustments are to be treated. Now let us see the preparation of the realization account. So in the realization account on the debit side, first we have to bring down all the assets in its book value, and on the credit side we have to bring down all the external liabilities in this book value. Now on the debit side, let's bring down all the assets to debtors 28,000. Now in the debtors we had seen PDD. So PDD has to be recorded on the credit side of the realization account as both are two different accounts. Next, we have to bring down the rest of the assets, that is stock 40,000 on the debit side of realization account. Next we have is two investments 20,000. Next we have furniture 14,000. Next we have buildings 60,000. So these are all the assets given in the balance sheet. So we had brought down on the debit side in its book value. Now we have to bring down all the external liabilities on the credit side of the realization account. The external liabilities are, first we have bills payable. So by bills payable 6,000. Next we have creditors. By creditors 20,000. Next we have is Vanita's loan, as Vanita is not a part of a partner. So it is treated as external liability. By Vanita's loan 5,000. Now these are the external liabilities which have to be paid off by the firm. Now the assets are to be realized. So some assets are realized and the liabilities have to be paid off. The assets have to be realized or it has to be taken over. So first let's record all the assets that are being realized in the realization account, which will appear under bank account. So on the credit side, we will write it as by bank account. That is the assets that are being realized. So let's write it on the credit side as by bank account. The assets realized are debtors are realized at rupees 25,600 as given in the adjustment. Stock is realized at rupees 39,000. Buildings is realized at 65,000. And investment, as per the adjustment, 50% of the investment is being realized at 20% more. So it is 12,000. So the total assets that are realized are 1,42,600. Now in these assets, not all assets are realized. So if you see here, the investments 50% is realized and the remaining 50% is taken over by the partner Anita. So Anita's capital account has to be written on the credit side of the realization account. So we are going to transfer the investment which is taken over by Anita on the credit side as by Anita's capital account. So that is the remaining 50% of the investment which is taken over by Anita at 10% discount. So it is the investment which is being taken over by Anita. So that is rupees 9,000 as it is taken over at 10% lesser. So it is rupees 9,000 which is the investment taken over by Anita. Now if you see on all the assets, one more asset is not being realized. That is, one more asset that is not realized is furniture. So this furniture is taken over by Sunita. So which should be transferred to Sunita's capital account as by Sunita's capital account, furniture taken over rupees 12,000. So now all the assets are realized and some assets are being taken over by the partners. Now, with these assets that are realized, we have to pay our liabilities. So, the external liabilities are bills payable, creditors, and Vanita's loan. As nothing is mentioned in the adjustment, we assume that all these liabilities are paid in full. So, we have to pay to the same value which is given in the balance sheet, which will appear on the debit side of the realization account as to bank account. So let's write it on the debit side as to bank account, that is liabilities paid off. Bills payable is paid at rupees 6,000, that is the same value which is given here in the realization account or in the balance sheet. Creditors 20,000 and Vanita's loan 5,000. So the total liabilities paid is rupees 31,000. Now, once the liabilities are paid, here the last adjustment says that Anita has taken the realization expenses. So, Anita has agreed to bear all the realization expenses. Therefore, it is the personal liability or the responsibility of Anita to pay the realization expenses, for which she is being paid with certain amount of rupees, that is rupees 2,600. So we will ignore the actual value of expenses 2,000 and enter 2,600 in the realization account on the debit side as to Anita's capital account, which will be the remuneration for taking the dissolution expenses 2,600 on the debit side of realization account. Now, once all the entries are being done, let's find the balancing figure. Let's find out whether it is a realization profit or loss. So write the total. Now when you see the total, credit side is 1,96,600 and debit side is 1,95,600. So credit side is more than the debit side. So write the same total on both the sides, 1,96,600 and deduct the debit side total. So it will be the realization profit. So this profit should be transferred to the partner's capital account equally. So two profit transferred to Anita's capital account. The profit will be rupees 1,000, that is the balancing amount, 1,000 rupees. So 1,000 into 1 by 2, 500 for Anita, and Sunita's capital again 1,000 into 1 by 2, which is 500 for Sunita. So both are sharing the profits equally. So this is the realization account and the profit is rupees 1,000, which should be transferred to the partner's capital account. So now let us prepare the partner's capital account. So first we have to bring down the balance from the balance sheet. That is by balance brought down, 50,000 for Anita and 50,000 for Sunita. Now next, in the partner's capital account, we have to bring down the reserve fund. That is from the balance sheet by reserve fund, rupees 30,000, which should be shared between Anita and Sunita equally 1:1. So it is 15,000 for Anita and 15,000 for Sunita. Next, we have to bring down is the realization profit, which we derive on the credit side of partner's capital account. So in the realization account, we derive that profit. So write it on the credit side by realization account profit. So 500 rupees for Anita and 500 for Sunita. Now, in this particular sum, Anita had taken over the dissolution expenses, so the firm is paying remuneration for this partner Anita. So this remuneration will have to be credited to the Anita's capital account. So write it as by realization account, that is the remuneration which is being transferred from the realization account to the partners. So it will be by realization account rupees 2,600 under Anita's column. So that is the remuneration paid by the firm. Now once these entries are done, now we have to take the assets and that are being taken over by the partner. Now Anita and Sunita have taken over some assets from the firm. Anita had taken over 50% of the investments and Sunita has taken over the furniture. So, this asset that is taken over by the partners will appear on the debit side of the partner's capital account. So, it will be recorded on the debit side as to realization account, the asset that has been taken over by the particular partners. So, Anita takes over investment at rupees 9,000 and Sunita takes over furniture at rupees 12,000. So once these entries are being done, now we have to find out the final balance, that is the final settlement to be made to the partner's capital. So let's find the total now. The total of the partner's capital account, the total of the first partner, Anita, total will be 68,100 and on the debit side, write the same total 68,100 as credit side is the greatest total. And for Sunita, the total will be 65,500. The credit side is more, so write on both the sides 65,500. Now this credit side total should be deducted with the debit side total to find the final balance or the final settlement that has to be made to the partners. So here the balance will be transferred to the bank account. So to bank account, that is the final payment made to the partners, the balancing amount 59,100 for Anita, that is 68,100 minus 9,000, we get 59,100, and for Sunita 65,500 minus 12,000 will be 53,500. That is the final settlement made to the partners, which should be transferred to the bank account. Now let us see how to prepare the bank account. So this is the bank account. First in the bank account, we have to bring down the opening balance from the balance sheet. That is the bank balance from the balance sheet. So this will be true balance brought down 6,000, which is given in our balance sheet. Now next we have to write down the total of all the assets that are realized. That is the amount that is received by the firm on dissolution of a partnership firm. So through the assets realized. So it will be recorded on the debit side as to realization account. That is the total amount of assets realized. That is 1,42,600. Now on the credit side, we have to record all the payments that are made by the firm. So first the payments made towards the liability. So it will be by realization account. That is the liabilities paid. Total amount is 31,000. Now here, there is no dissolution expenses paid by the firm as it is being personally taken by Anita. So it will not be transferred to the bank account. Now next is the internal loan. Anita's loan. Anita has lent loan to the firm. So this loan will be an internal liability. So this will be appearing on the credit side of bank account. So as by Anita's loan account, that is the internal loan, rupees 5,000 on the credit side. And finally, the partners are being settled in the partners' capital account. The final payment made to the partners. That is, by partners' capital account, Anita's capital balance was 59,100 and Sunita's capital balance was 53,500. So the total capital paid or settled to the partners is 1,12,600. So now, after all the entries are done, find the total of the bank account. The total will be 1,48,600. So the credit side as well as the debit side will be the same total, 1,48,600. So this is the bank account prepared under this particular sum. Hope it is clear, students. We will see another sum with a different adjustment.